The headlines are screaming about shadow defaults and PIK toggles in the direct lending market. But is it a real crisis or just media noise? If you've been reading the financial news lately, you've probably seen the doom and gloom headlines about direct lending. They're calling it the next big bubble, pointing to something called shadow defaults and PIK toggles. But are we looking at a systemic collapse or just a normalization after years of cheap money? Today, we're diving into a deep dive report from StepStone Group titled Cutting Through the Noise in Direct Lending Headlines. They're arguing that the media is missing the forest for the trees. Let's break down what's actually happening. The shadow default. Boogeyman. First up, the shadow default. This sounds terrifying, right? The media uses this term to describe companies that aren't technically bankrupt, but are struggling, using maturity extensions or covenant waivers to stay alive. What's the take from one of the largest managers in the world? StepStone? It's a misnomer. While headlines say these are skyrocketing, StepStone points out that these amendments are often proactive management, not just a precursor to failure. In fact, while actual payment defaults have ticked up slightly from the 2022 lows, they are still way below historical averages. We're seeing a normalization, not a crisis. PIK toggles and interest burdens. Next, let's talk about PIK, payment in kind. This is when a company pays its interest with more debt instead of cash. Headlines claim this is a red flag of a dying borrower. StepStone provides some nuance here. Yes, PIK usage is up, but it's often a strategic toggle built into the contract to help companies manage cash flow during high-rate cycles. It's a feature, not necessarily a bug. However, and this is my reaction, you still have to ask, at what point does the compounding debt become unsustainable? StepStone is optimistic, but as investors, we have to watch the interest coverage ratios closely. 5:37:30. Point 3, the valuation opacity. The problem, one of the biggest criticisms of private credit is that it's opaque. Unlike public stocks, you can't see the price change every second. Critics say managers are marking to model or marking to magic to keep fees high. StepStone pushes back, noting that while there isn't a secondary market trading these loans daily, the fundamentals, leverage levels and LTVs, loan to value, have actually stabilized. They argue that the private nature of these deals allows for better senior secured positions that protect you better than the public high-yield bonds. So what's the verdict? My take is that StepStone is right to call out the sensationalism, but we shouldn't be complacent. The noise exists because the environment has changed. We are no longer in a zero interest rate world. StepStone's advice for 2026 is solid. Prioritize senior secured positions and avoid ARR-based, revenue-based lending in volatile tech sectors. Direct lending isn't dying. It's just growing up, and the era of easy wins is over. You have to be a hunter, not just a gatherer now. Is private credit a core part of your portfolio, or are you staying away until the shadow clears? Let me know in the comments. Don't forget to like and subscribe for more deep dives into the private markets. See you in the next one.